Thank you, Brian, Rockwood Bank. Appreciate it. So today I'm going to talk about taxes and how you can keep more of your money. As I talk today, let me give you a brief background. I've been a CPA for 30 years. Different firms, self-employed for the last probably 5, my own firm. I joined E3 Consultants Group about 7 months ago. So I merged my firm in. E3 Consultants Group is a consulting firm with 3 arms. They have a wealth management division, a tax division, and a marketing. So with 3 locations for the tax service, Wildwood, Missouri, Sunset Hills, and then we have a Kirksville, Missouri office. Probably 20 staff, 5 CPAs, some enrolled agents. So yeah, we're growing. I am also licensed for securities for the last 20 years, approximately 1997. So yeah, I joined E3 and everything's going well. So today, I'm gonna talk about the tax code. As of today, I'll just give you some brief news. The Tax Act passed the Congress today, so it's going to the Senate. It's reinstating a lot of the expired Bush tax cuts, what they call them. So the name of this bill, it's kind of funny, I guess each party names it. It's called the Protecting Americans from Tax Hikes Act of 2015, PATH for short. So anyway, it's going to the Senate. It should pass and the President should sign it. Just before I get into the presentation, this is good news. It's a little late in coming for especially small business owners that one of the big breaks for small business is the Section 179 expensing deduction for purchasing equipment, computers, equipment, or whatever. It went back down to $25,000 from $500,000. So what this act has done has permanently set that level at $500,000. So all we're saying is you can expense rather than depreciating equipment, and equipment up to a $500,000. So, even for small self-employed people that are buying buying equipment or whatever, or the bank, they're now allowed to accelerate their deduction. For young families, it permanently puts into place the American Opportunity Tax Credit for college expenses. So that $2,500 credit, which a lot of my clients like, is set as permanent, not to expire anymore. And the HOPE credit. So you take the better of the two. So there's some good things in this Tax Act that they made permanent. The child tax credit, for those that just had new babies, you get a $1,000 tax credit for each child you have up to age 17. Once they turn 17, you don't get the $1,000. I get a lot of clients saying, I got a senior in high school, living under my roof, paying food. Why don't I get the $1,000 credit? I said, well, he's over 17. That's Congress's wisdom that, they don't give us that. So anyway, that's permanent. American Opportunity Credit. A couple other things for mass transit. It's like Prepview in New York. If you're a teacher, there's a $250 deduction if you're a teacher for buying supplies for your classroom. So anyway, we've been waiting for this. So it looks like it's going to be retroactive to the beginning of the year, and it's permanent. So let me get into, and please, if you got any questions, this is a small group, so let's just, I'm here to help you save taxes. So if you got a personal question, just let me know. So I remember the good old days when taxes were simple. The tax code is 100 years old. Back in, anybody know when the first tax returns were filed? It was 1914. It was basically pretty simple. You could get a 30-day extension, but anyways, very simple. Today, the code is approximately, Steve, do you have the code with us? Okay, it's 9,000 pages, just so you know. as of today. So much for tax simplification. You know, it's just getting more and more complicated. I went to a 2-day tax seminar last month and a half a day on the Affordable Care Act and how that's going to affect tax preparation this year. The other half a day was on these repair, you probably haven't heard of these repair regulations. If you have a rental house or if you have and you buy something to improve it, the house or, a new furnace, they want you to, again, depreciate it. So the new limit, fortunately, got raised to $1,500. So, you don't have to worry about, buying a hot water heater and having to worry about depreciating it. It's just, it seems to me like they're really going after things that are affecting the little guy. And I don't understand it. But anyway, that was 2 days of that. So let's see. 9,000 page code. Let's see. I handed out some key rates for 2000. Let me go back. Yeah. For 2000, in your packet, I gave you this little brochure. So in here, it's got the federal tax rates for 15. So if you're married, filing joint, the 0 to 18,450 is 10%. This is taxable income. So this would be after your itemized deductions and after your personal exemptions. The next 18 to 74,000 is taxed at 15%. And then 74.9 to 151 is you're in the 25, what we call the 25% marginal bracket. Okay, so it just means you make a dollar more, you're paying 25% on that dollar. And you can see it for single head of households. And the thing that a lot of people don't realize is on estates and trusts that the tax rate is very, very high. So when somebody passes away or you set up an irrevocable trust, if you make over, just $2,500 in income, you're in a 25% bracket. So, the trust that we prepare, we always see it's usually passed out to the individual and have them pay it at the individual rate rather than inside the trust. And then the standard deduction on page 3 this year is $6,300. So if you don't itemize, if you don't have enough to itemize your deductions, and you're married filing joint, you get $12,600 as a deduction. So that went up a little bit from 14. And then personal exemptions. Everybody gets a personal exemption. You, if you're married, you, your wife, any dependent children, is $4,000. So that's a deduction. So that went up a little bit. So those are pretty much the new rates. We'll get the $1,000 tax credit for any kids under 17. They just passed that. They're really, other than these changes from 14 to 15, I don't see a whole lot of new tax law changes. So I'm really going to focus on just, things that you can deduct. I mean, okay, dividends. Does everybody understand qualified dividends and non-qualified? Qualified dividends are normally paid from U.S. corporations. So Walmart, Coca-Cola, even though they're global companies, you get a brokerage statement, we look at it, we like to see qualified dividends. They're taxed at 15% unless you're in the highest tax bracket. So that's good. You could be in a, you guys are both working, you're husband and wife, you're in a 25% tax bracket, you got some nice stocks that are generating dividends, 15%. So that's, that's our one break. Same amount of money on a CD or interest income, sorry, that's taxed at ordinary income rate, 25%, if that's your rate. So we like qualified dividends. Non-qualified would be like maybe a foreign corporation, I don't know, Volkswagen, BMW, whatever, would pay a dividend. Those are non-qualified. So they're just ordinary income. Okay, this is the new tax. That net investment income tax was due to the, with the Affordable Care Act, the Obamacare, what they call Obamacare. If you're married filing joint and your joint income happens to be over that 250, there's a 3.8% tax on your net investment income. Net investment income, interest, dividends, capital gains, rental income, annuity income. So it was an additional tax last year. I think that came into effect in 2013. Yeah, it did. So, interest. Actually, let me take that back. Net investment income includes interest, dividends, capital gains, rental income. So if you got a lot of rental houses and you make $250, you're going to pay an extra 3.8%. So we really got to, plan for that. Does not include, your adjusted gross income for this computation doesn't include Social Security or alimony or anything like that, or self-employment income. So it's just an additional tax that was imposed to pay for that Obamacare. Let's see. We got exemptions and deductions. Love it. Let's. So like I said, standard deduction 12.6. Let's see. Alternative minimum tax. I won't go into that right now. That's getting a lot more people are getting caught in this AMT, and I'll go over that a little bit later if somebody's got that question. But there is an exemption. It's indexed for inflation, so that went up. I just want to go over a couple things on office in the home. I don't know if you've got a self-employed business, or maybe you're working from home. You can deduct a portion of that office in your home. So even if you have a job and you may start a side business, whatever, direct sales, maybe some kind of, whatever. And you do administrative work at home, you can deduct that portion of the house. A couple different ways. You can take that square footage of that room, divided by the house, say that's 5%. Okay, now you can deduct 5% of your insurance, which is normally not deductible. 5% of your, real estate taxes and mortgage interest are already deductible, but things like you can do utilities, landscaping. So it just opens up some more deductions that are legitimate deductions if you use that home. And that's one way you can count the number of rooms in a house. 1 divided by 7 rooms, take that percentage. So it's good for you if you've got this side business or you're self-employed. There's also a simplified method. If you don't want to keep track of all that stuff, it's It's $5 per square foot. So maximum 300. So a lot of lazy preparers will just say, okay, we'll take, $5 times $300, $1,500 deduction for your home office. But if you really work it through, I can usually come up with more of a deduction than the simplified method. That's what I was just talking about. Regular method, deduction, self-employed. Okay. Again, expenses directly related to the home office are 100% deductible. So in that office space, you buy desk, chair, computer, painting, carpet, that's 100% deductible for that office space. You don't have to apply that percentage. These repair regs, I'm not going to spend a whole lot. They were, like I said, $500 per item, and then it was raised, I believe, to $1,500 this year. So I don't want to go too much into that. But this is big on rental properties. I mean, you have to have an accounting procedure in place. In my opinion, ridiculous, but I mean, the IRS has their rules, I guess. It was just a lot of paperwork to cover, for something I just didn't quite understand. Because if you bought a furnace or something, you could Section 179 it anyway. So anyway, estate and gift taxes. Does everybody realize you can gift to anybody a certain limit per year tax-free? We all know that, right? You might know the limit. Pardon me? 14,000. So, somebody that's in a higher, wants to start gifting to their kids or grandkids, I can give 14 and my wife can give 14 to my son and to his wife. So we can give away 28 grand tax-free. I can give stock to them. If you gift stock or you gift like property, they take over my cost basis in that. So if I bought, InBev stock at 50 and it's worth 150, I give them 100 shares, their cost basis is my 50. So you always take over the donor's cost basis. Fortunately, they didn't do anything with estate tax. State tax is still $5,340,000 per person. So when somebody passes, you add up all their assets, including life insurance, their share of the house, their assets, if it's over $5.3 million, you've got an estate tax. So it's, we don't run across it because husband and wife each have $5.3 million. So, when we have clients at that stage, we make sure that they have some trust planning set up, and it's divided pretty evenly. So yeah, 14,000 per recipient. Let's see. Tax changes ahead. What do we got here? This is, let's see. Yeah, this is talking about the extenders. I kind of jumped ahead. So that bill's been passed. From IRAs, you can gift directly from your IRA to a charity rather than taking the IRA. So if you're over 59.5, taking it out of the IRA, including in your income, and then giving it to the charity as a deduction. It's just a way of lowering your adjusted gross income. You could, if you take 50,000 out of your IRA, your AGI, adjusted gross income, might bump up too high to affect other things. So they let you just, I have clients that say, hey, I want to send, $1,000 to American Red Cross. It just goes right from the IRA so it's non-reportable. That was part of this bill. The penalty for, I'm not going to get into this Affordable Care Act. All right, limit on IRA rollovers. Hold on one second. So, you can take out of your IRA and roll it over. You've got 60 days to roll it back in. Maybe you need it for something. I'm talking you're over 59 and a half. You got 60 days. They changed this rule once per year. So I'm not talking about a direct transfer, like from a 401k or another IRA, and you direct transfer it to another one. That's fine. It's when you take out and maybe have to use it for something, you have 60 days to put it back one time a year. And that's the previous 12 months. So that was changed. The health insurance coverage, Affordable Care Act. Let's see here. See if I can get this to scroll down here. Here we go. The penalty this year is $325 or 2% of your income. So the new thing this year, Insurance companies are going to send out a 1095B as in boy. It's going to indicate if you have coverage or not and for how many months. So it's just an added. Basically, they've got the tax preparers policing the Affordable Care Act for the IRS. So, I mean, this 1095B is being issued by the insurance companies, United Healthcare, hopefully. Hopefully people bring them in and it'll show the coverage. If they don't have it, it was like $95 last year. It's $325 or 2% of their income. So for not having coverage. Let's see here. And so yeah, that's it. Health insurance, tax cutting strategies. Okay. For tax cutting strategies, basically what we're talking here is, you've got your dependency exemption, which is $4,000 for kids if you are supporting your dependent. You've got the, let's see here, you've got the child tax credit, which I mentioned already. Let's see. We've got, and it doesn't have to be a child. If you've got a relative living at home and you're paying for half the support. So, for instance, we had my mother-in-law live with us in the past, and, we basically supported her. She got Social Security income. You had to, add that up versus the total support. And if it's more than 50%, you can claim a relative if they're living with you. For family, let's talk real quick about state tax. A couple things on the state tax. The state of Missouri is what I'm referring to. The 529 plan allows you to deduct up to $8,000, $16,000 for a joint couple to put money into a 529 plan. So that's deductible on the state return. So that saves you 6% right off the bat. That money grows tax-free if you pull it out for qualified secondary education. So, it's the one break families get to save for college. And Missouri allows, every state sponsors a 529 college savings plan. I believe ours is Missouri most, but I could invest in Illinois' college savings plan. It's still a deduction from Missouri. You don't have to be tied to our plan. I talked about eligible students. You get it, for undergraduate school. University of Missouri, you got a kid going there, you get up to $2,500 for the American Opportunity Credit. It's for 4 years. You can only claim it 4 years. So be careful that first year. I get a lot of clients say, oh, my daughter took college credits at Lafayette High School, and whatever, or took some classes at SLU or whatever, and you don't want to use your American Opportunity Credit for that little bit of money. We take a different deduction. And I tell you, these colleges, they send out a 1098Q for qualified tuition, and a lot of time it's what's billed rather than what's paid. Anyway, we've gotten caught in the past where we've taken the deduction for 5 years, and they've caught it. So it's like that fall of first year, and then you got 4 years in that last year paying the spring. You just got to watch it. So somehow they caught it. They're good at some things. Let's see. Keep in mind. We usually weigh the benefit of a tax credit versus the deduction. There's an above the line deduction for, and then they still have the lifetime learning credit, which is for really anybody taking classes or furthering their education. There's a credit for that also. It's called lifetime learning. So the nice thing about that opportunity credit, even if you don't have, most people have enough tax liability to offset that for that $2,500 to offset it, but for some reason, if you had zero wiped out your income tax, 1,000 of it is still refundable. So it's like a 1,000 of that 2,500 is actually a refundable credit. Let's see. What we got here? Okay, investments. All right, love it. Let's talk investments. How we're gonna. So like I said, let me see. I'm getting messed up here, Steve. Let me go back to. There we go. Yeah. So I don't think people realize that when you sell a stock, it's a capital gain. The holding period for long-term capital gain is 1 year. So, if you're in the 10 or you get favorable capital gain treatment, just like on qualified dividends. So I hold that stock and I sell it after a year. I don't care what bracket I'm in, I pay 15% on that gain. If I happen to be in the highest tax bracket, that 39.6%, if I'm in that bracket and I'm making $400,000 taxable, I still only pay 20%. So that's still a great tax break for people. If I happen to be in the 15% bracket, let's see. So I don't know, I'm making 70 grand, 72,000 taxable. I might make 100 grand, but after my itemized deductions and exemption, I'm down to 72,000. And I'm in the 15% bracket, and I sell some stock, zero capital gain tax. Zero. So if that gain gets added and I'm over that 15% bracket, then you're going to pay 15% on the rest of that capital gain. But I got a lot of some clients that have a lot of deductions, and they've sold some stock, and portion of their capital gain is zero up until they get into that 15% bracket. So that's a good deduction. When you sell something at a loss, called tax loss harvesting. So this is a good time of the year to look at your losers, or clients that will do tax loss harvesting. So they may have some gains during the year, and it's just you can offset all your capital gains plus $3,000 of ordinary income, no more. So you don't lose it, but you carry that loss forward for 20 years. So look at your gains if you have any. If you don't, then maybe you just want to sell a stock, take the loss, buy it back in 31 days. Maybe you like the stock. Maybe it's just having a bad year. You tax loss harvest it and buy it back. It's got to be 31 days if it's a loss. Let's see here. Yeah, okay. And then we talked about the, let's see. Donating stocks. You can donate. Maybe you've got some stocks that have really low cost basis. You've inherited it. Rather than giving cash to a charity, donate the stock. Get a deduction at fair market value. Charity sells the stock, no gain. They don't pay they're a nonprofit, so they don't pay a tax on the gain. That's a good tax-free munis. Buy munis. I don't know. They're probably paying 4%, something like that. Buy Missouri munis. Good, double tax-free. It's got to be a Missouri muni. So municipal bonds are tax-free on federal. If they're Missouri, they're tax-free on both, on federal and Missouri. Let's see. This is just, I mean, it's more for, you know, you hear these terms, covered securities and non-covered. It's just the cost basis has been reported to the IRS. We get a lot of brokerage statements that, you know, and I'm not going to get, but we get a lot of questions what the difference is. It's the brokerage firms, you know, should keep track of your cost basis, and those are considered covered. It's really, it's securities bought after a certain date. So anyway, business, love it. Okay, just talking about this with a lot of our advisors. They're independent contractors. So as an independent contractor, you have the choice of incorporating. Most common is an LLC structure, a limited liability company in Missouri. Very easy to set up, very inexpensive. You get articles of organization. Single member LLC provides you the protection of a corporation. You report it on your individual return. So even if you got a side business, you're doing something, why jeopardize, you know, a lawsuit in these days? Set up an LLC, it's real simple. No annual registration, no separate tax return. Technically, if it's a husband and wife, it's a partnership. So we recommend just doing a single member LLC, and it goes on your Schedule C, which is a profit or loss from a business. Take all your deductions as normal. The other way I tell some advisors is, well, the only thing is, you know, you're self-employed and you come to the bank for a loan and they say, well, give me your W-2, and you don't have one. You got a Schedule C to give them. And I mean, that's kind of a catch there because, you know, we're all trying to take legitimate tax deductions on the Schedule C, auto, home office, things that are allowable, but it brings that taxable business income down. So doesn't look so good when you're trying to get a loan. So I tell them, you know, maybe you want a W-2, so we form an S corporation, and it's just a separate tax return. It's a flow-through entity, just like the LLC, but the advantage is you get you take a wage. The other, I'm not going to call it a loophole. It's just taking advantage of the S corp laws. It allows that owner to take S distributions, which avoid payroll taxes is all it does. So, you know, you got to be reasonable. You have to take a reasonable wage out of that S corp. What's reasonable? You know, just don't get. I just tell my clients, don't get, you know, too crazy about it. You know, just what would you pay somebody to run your business? Then that should be the wage, and take the rest out as S distribution. And you can save some payroll taxes. Typically, I don't like seeing it more than 50-50, you know, 50 wage and 50 S distribution. Just be reasonable about it. The other regular structure, we don't see a lot of them set up as a regular C corporation. That's where the corporation actually pays the tax. So we're really not seeing too many of those. I'm not going to, Affordable Care Act, it's now 50 employees. If you hire more than 50 employees, you're supposed to provide health coverage. We have got 2 resources in the office that if you have questions on medical or health insurance type issues, we have a really good resource. And then if you have a question on Medicare or know somebody, Medicare or supplemental insurance, we have a Social Security expert that, you know, just come, I've got their emails I can give you. But these are becoming a really specialized area. I you know, from a tax standpoint, we're going to be looking for that 1095B. That's, you know, just to make sure you've got coverage. So your tax preparer is going to ask you this year. That's if they didn't last year. Retirement plans. So, yeah, let's talk about retirement plans. If you're a small business or if you're self-employed, you can do a SEP or a single K. I like this, you know, I like the SEP. You can do up to 25%. You can do of your self-employed earnings or of your wages. You know, if you're self-employed, I got some attorney clients that have a, you know, a single K. A single K, you can defer just like a regular 401K. The limits this year for 18,000, so you can defer. Yeah, 18 with a catch-up of, let's see, of 5,500. So that's a, you know, a single K is really nice if you need to borrow against it. It acts just like a big 401K. So you got two choices. The thing about a SEP, you can do your Schedule C, you know, for your business, and you've got until the filing date to fund it for the prior year. So it's really a nice, you know, maybe you don't have the money at the end of the, when you're filing, you know, or at the end of the year. Well, you've got until April 15th plus extensions to fund that SEP. So that's pretty good. Let's see. Oh boy, passive. I'm not gonna. The rules here really relate to rentals. Okay. Normally rentals are passive. They're passive activities, and all that means is if they generate a loss, you can't. I get more clients that have some rental losses, and they go, "That's good." I go, "Yeah, it's good, but you can't deduct them." I go, "Why not?" Well, you made over 150,000 combined, and there's just this limit between 100 and 150. If you make over 150, those losses are no benefit to you. And I said, wait a minute. Well, you don't lose them. They carry forward. So these are operating losses. You know, you get your rental income, you get your deductions, depreciation expense. It's going to create it's a good tax loss, rental real estate, unless you make over 150. So there's a catch to this. It's if you materially participate and you are, quote, a professional, you know, real estate activity, you then can deduct those losses. So, like I said, you don't lose the losses, but they carry forward. When you sell the property, you take them all. Take all the losses. Doesn't matter how much you make. You can be making $500,000 that year. You sell that rental property, you can take those losses. Let's see, what else we got here? Retirement. Okay, here's the limits. So if you work for an employer, 18,000, the catch up, if you're 50 or older, 6,000. That's your money, you defer. Normally the company has some kind of match provision, okay? But that comes right off your W-2 earnings. So on box 7 of your W-2, it'll show 18,000 less than what you actually made. Roth and traditional, 5,500. If you're over 50, extra 1,000. Roth grows, can't deduct it, grows completely tax-free. You can take it out. It's your money. It's got to be in there actually 5 years. You can take it out, you know, no penalty after 59.5. If you take it out before 59.5, you're just paying a penalty on the earnings. I think 10% penalty, but it's the money you put in is your money. So the key, you know, is to keep it in there for retirement. It's completely tax-free. The government doesn't tell you at 70.5 you got to start taking it out of a traditional. You don't on a Roth. These are the limits, so you're married filing joint and you make over 118,000, you just can't do an IRA. I mean, I don't get it, but that's the rule. And then, let me go back. So the other thing is, if you are working for an employer, but you have a side business, you can still set up a SEP or a single K for that side business, even though you have a retirement plan at work. So don't think, well, I already maxed out my 18,000 or 23 at work. If you've got a side business, you can still do a SEP. Tax efficient required, that's, everybody knows that at 70.5, you have to start taking out of your IRA. It's a divisor, it's just a scheduled, and we have a schedule for that. If you have an inherited IRA, that is a different than taking out of your own IRA. So there's two different schedules. Just so if you inherit somebody's IRA, it's typically taking out of over the life expectancy of the oldest beneficiary of that IRA. If they've split it, you just take it out. You take it out over your life expectancy versus this other schedule. Timing of initial, a lot of people turn 70.5. You got to take it out by the April 1st of the next year. So we do a little planning. You don't want to have to take it, some people wait to take it out at April, but then they got to take another one by the end of the year. So you just don't want to, you want to watch it. You don't want to bunch it.
Mark, what happens if you don't take out that
excise tax, 50%.
So I don't take it out, I got to pay
50% to the IRS for not taking it out. 50% of that required, if you were supposed to take out 10,000 and you didn't take it out, 50% penalty. And when we have clients that have IRA, we do this every year, we try to ask them, and you don't have to take it out of every IRA. You can group your IRAs, total them, divide by whatever the divisor is, come up with an amount. You can take that amount out of just one of those IRAs. You don't have to take. So we just make sure that we're capturing all their IRAs out there so they don't, that's a big penalty. Estate planning. I can't tell you how many times I come across titling problems. Please check your beneficiary forms on everything. We see this so many times. They got a trust. Oh, great. Why is this account titled in your husband or wife's name? What do you mean? It's a joint account. I go, yeah, I know it is. You're going to go through probate on that one. Let's get it in the trust. Or I'll see these, dividend reinvestment plans. They're big. Computer Share is a big transfer agent. They'll have stock in McDonald's or whatever, IBM they're reinvesting. It's in the husband or wife's name, but they got a trust set up. Well, it's going to, you're opening up an estate, a probate estate, if it's not in your trust. Missouri is really good on TOD, POD transfers. So if you don't want to pay for a trust, that's fine. Get your accounts, TOD, get your house, get a beneficiary deed on it. Real easy. Go to the title company, file a beneficiary deed. You've accomplished the same thing. If you don't want to pay $2,000 for, we've got a great resource in our office for estates and trusts. But you don't want to do that, then I just, and then for some reason I'm getting a lot of divorces and my clientele, and it's just, you got to make sure your life insurance is changed, your beneficiaries on. So I'm really particular about that when I do a tax return. I don't know why. It's important. Identity theft. Did anybody have identity theft in the room last year on their tax return? There was a statistic what I had it here, there were like 1 point here, tax tips for owners from the experts. This was like out of St. Louis Small Business Monthly, December 15. 1.4 million individuals have been notified that someone else filed under their Social Security number. So I think I did 400 returns. We approximately had probably 5%, 20 with identity theft. That 5% among my colleagues is pretty prevalent. So I don't know how it's happening. I don't know if they're surfing the web. I don't, you know, there's been some data breaches at different places. But you have to file a identity theft form affidavit. The proof is on you. We have to get a copy of your driver's license, your 2 forms of ID. We advise you to, file a police report, call the Federal Trade Commission. They link those 2 numbers. You then get a PIN number. And it takes a long, it's running 6 to 9 months to get your refund. I don't know what the IRS is doing about it, but I hope you would think with computers today you could somehow identify who is transmitting, because most returns, we are required to file taxes electronically. So, and we have an ERO number, or electronic origination number. You would think they could track that, but apparently not. Let's see what else I got here. So that's really, that was, just be careful with your social. Here's the other thing, guys. Keep your Social Security, monitor your credit report. We've got a good credit reporting service that we know of. Never give out. The one thing, the IRS never calls on the phone, and they never email you, okay? Just remember that. So if they say they're IRS, they're not. If it's on a call or an email, it's always written correspondence. Individualized beat. I think that's really it. I'm going to wrap up. One other thing I want to talk in Missouri, if you're charitably, orientated, Missouri has some really good credits, NAP credits, a neighborhood assistance program. This one, for instance, from the and one of our kinds of the YMCA. Okay, you basically, it costs you about 25 cents on the dollar if you can get some of these neighborhood assistance. I have a friend on it, Arlo Haven. Same thing, neighborhood assistance, or can't remember the credit, but basically you get a deduction on your federal return for charitable, deduction, and then Missouri gives you a 50% tax credit, not a deduction, off your Missouri tax. So $100 deduction over here, I'm in the 25% bracket, I save $25. $100 in Missouri, I get a $50 tax credit. I just saved $75 on taxes. I help the charity, cost me $25 on 100. So these are out there. This was Special Olympics for Missouri. That was one thing. Ask the experts. It was all pretty much what I covered. 529, charitable deduction from an IRA, stacking your, if you pay estimated tax payments, pay your Missouri tax by December. That's because you deduct your state and local taxes on your federal return. So there really wasn't anything, like I said, out of the normal. I mentioned AMT tax. I got to tell you, it's just hard to get out of it. AMT takes your adjusted gross income and adds back all your taxes. So all your withholding taxes, your real estate taxes, your estimated taxes, and they come up with a number, and it's a flat 26%. It's just, it's affecting a whole lot more people. This was on the 529 plan. Audits. Here we go, I'll wrap up. Let's see here. In 2014, the IRS audited 1.5% of the more than 4 million tax returns filed, calendar year 2013. So, article just talks about how they're understaffed. They're going to go after more Schedule C, S Corps. 1.5% audit rate is not very high. And other than that, one other thing I wanted to point out on, like I said, we've got a Medicare specialist in the office, and he wanted me to mention Social Security filing strategies, although it doesn't relate to my tax speech, is important because there's a lot of different options to file and suspend and take it early, or do I wait? Rich Grauer's in our office, and he's spoken here. But basically, the file and suspend strategy is going away effective May 1st. So if you know anybody that's approaching, or, retirement age, or maybe they're deferring, maybe they're 62 and they don't know, it's just that strategy is going away. That's where you file and you say, hold my Social Security benefits, grow them at 8% to age 70. That strategy and the one where the spouse could then, you file and suspend, but the spouse starts taking half of yours. I'm not an expert in this, but if you have anybody has questions, I'll give you Rich's email. Those are changing, so that's really important. It's other than that, I think that's all I have. So, like I said, the good thing that came out of it today, I guess, is the tax extender bill. This PATH Act is in the Senate, and I think the President's going to sign it. So, looks like we got our permanent deductions for some of our key deductions. So, with that, I'll open it up. Any questions? Yeah.
On the education, it says savings bond income exclusion.
Yes.
So if my daughter has a bunch of savings bonds from when she was first born, and this is giving her last year, she's in grad school. If she would cash in all of those, how do you say that those savings bonds were used for?
Yeah, there's a form, and I can get you that to show that those savings bonds were. It's a separate form to show that.
Oh, okay.
Yeah, we don't see a whole lot of people. We just don't see a whole lot of savings bonds. I mean,
Right, because really old.
they're really old. Yeah.
23 years old.
Yeah, get with me. I'll get you some information on that.
Okay.
Yeah.
Thank you.
Yeah. So yeah, bro.
You know if there's certain profiles or anything that are focused on more by the IRS to trigger any kind of...
Yeah, they said what I've been reading here is they're actually going after the higher income individuals this year, meaning millionaires.
Right.
They're going to audit more higher income tax returns and those Schedule C's, rentals, and S Corp, returns.
So if you're a typical W-2 employee and you have an accounting firm that does your taxes for you every single year, do you think that would be less scrutinized than somebody who...
Highly unlikely to get less than a half of 1%.
Why?
I mean, very unlikely.
Even if you want to even...
Yeah, the two audits I had, one was really a corporation audit, and it flowed over to the individual. And I'm trying to think the other one. They were not. They were both business related. S Corp. One was a C Corp, accumulated earnings tax. They said they built up too much earnings in their corporation.
You can do whatever you want, no matter how good.
Well, what do they say? Pigs get happy, hogs get slaughtered. Don't get too aggressive. It's a. So, all right. Well, thank you.
Are there any,
Yeah.
you're saying that you could be a W-2 employee and also have a home office with a business on the side? Are there any income guidelines related to that side business?
Not particularly. You have to show a profit motive. So don't be afraid if you got a loss for a couple of years. But if you show the agent that you're trying to make a profit, I can argue that. And I mean, when I say try to make a profit, do you have, some kind of records of what you're doing, appointments? Are you just simply, creating a loss? And I'm not even afraid of you're supposed to show a profit 2 out of 5 years. If you can show me you are trying and developing a business, you're okay. Yeah.
Now, aren't there some repercussions in doing that, in the sense of if you have a home office, if you decide to sell your house, you can't consider that square footage as part of your house or something like that?
Just had this discussion in our office tax summit, and some of us tend to be more aggressive than others, but you are correct. I think I stood correct in my one colleague. If you sell that house, technically that 5% of the house that you depreciated is a gain, if you've made a gain on it. Because normally, as you know, one of your tax-free assets is your main home. You can sell it for you don't have to reinvest it anymore. You can make a profit up to $550,000 on that home and not pay tax. So, those rules where I sold my house, do I got to reinvest it in another one that's more, those went out. So, yeah, so that's, those are tax-free sales, your home. We always ask, clients when they come in, these are your tax-free assets, your Roth, cash value life insurance, your home, not your second home. But we live in a great country. You can deduct interest on 2 homes, your first and your second. So.
Not your third, huh?
Now you're third. No. Now you're third. Well, so.
A non-for-profit, donate my primary residence to the non-for-profit.
Yeah, we'll talk about that. All right. Well, thank you. I appreciate it.
Thank you.
Okay.